Hello everyone, thank you for coming. My name is Maria Zalewska. I am a third-year law student at the LSE, and I initiated this event. It is therefore a great privilege to be co-hosting with LSE's Financial Market Group and LSE's Fintech Society. And I'm very thankful to both for helping to turn my idea into a reality, as well as assisting with advertising and organizing the event. So why the four corners of fintech? I really don't think that there's a need to convince any of you that financial technology will constitute a crucial part of our future in one way or another. Unfortunately, however, in the news, it is seldom discussed as anything more than an efficiency enhancer for the financial services sector or a disruptor to traditional banking models. And I felt that this was a great shame. The use of financial technology brings key regulatory, social, and legal challenges, and these had to be discussed. So tonight's event will aim to be somewhat of a first, offering a holistic, four-corner perspective into the value and future of fintech. You will shortly be hearing from our expert speakers. Many thanks to Zhao Meng, Irina Velkova, and Julian Cunningham-Day, who are representing China Digital Index, Grant Thornton, and Linklaters for accepting to present today. A final thank you to Semyon Dyankov from LSE's Financial Markets Group, who previously served as Finance Minister of Bulgaria and was a Chief Economist at the World Bank. He will be acting as chair for today's event. So I'll now hand over to Joseph, who is president of LSE's Fintech Society. He'll tell you a bit more about that, but beyond that, I hope you enjoy.
Thank you. Yes, just quickly from my side, thank you all so very much for coming. My name is Joseph. I'm co-president of the LSE Fintech Society. And it is a particular pleasure to have you all, and especially our distinguished speakers here tonight. We founded the society last year with the aim of creating a debate on campus around fintech that explores not only fintech's facets, but also its corners. So it is a pleasure to have you all here tonight. Thank you very much. Just quickly, a short note about the Fintech Society to all the students amongst you. We are organizing a one-day Fintech conference on March 1st. So if you want to explore Fintech further and its facets further, then you can find more information about it under www.londonfintechsummit.com. Yes, thank you very much.
Thank you. And a few words from me. Development economists, like myself, have been excited about this emerging topic, fintech, over the last couple of years, because it offers potentially answers to some questions that we've been raising for literally for decades. Namely, how to include people around the world, both in emerging economies as well as in some advanced economies like the United Kingdom, how to include people in economic activity, in entrepreneurship, in business that for one reason or another are currently excluded. That exclusion takes different manifestations, but one clear manifestation is that if you don't have access to finance, if you're excluded from the financial sector, it's very difficult to do business. And it's also very difficult to pull out of poverty if you're in many countries in the world. So what are the numbers? The numbers sound very promising if we can understand well what fintech is about. Our distinguished speakers will tell us about that. And then figure out how to include many people. Currently in the world, about 2 million people don't have access to a bank account. They're not bankable, so to speak. Of these 2 billion people, however, about 1.2 billion people, so more than half, actually have cell phones, some sort of a cell phone. So potentially, they all can be included, financially included, if we can figure out not just the financial aspects of what is it that currently is lacking for them to use these cell phones as instruments for inclusion, but also what are the regulations or laws that need to be in place to make this to be a safe instrument. And this is in some sense exactly the type of questions that I hope we will be answering today. So of 2 billion people, about 1.2 billion are just waiting for us to give them the right answers, and their, of course, their policymakers on how to be included. Even more optimistically, of this 1.2 billion people, about 450 million people not only have a cell phone, but have at least one type of transaction that goes through financial transaction online. So they may be receiving their salary, for example, online, or they may be paying some sort of a bill online. So at least one type of transaction already is financially available over the internet or over their phone. So then the challenge is how to use this early access to basically spread it to more services, again in a safe manner. And then a final number, just to show that economists believe in numbers, is that this is not just an issue in developing countries. We have some very advanced economies where online services are very well developed. Germany is an example, but still currently, early 2019, in Germany, less than 15% of the population actually uses online financial services, not just for banking, but for anything, for paying some sort of a utility bill, or for optimizing your financial portfolio, anything. Less than 15% in Germany. And actually, if you go across continental Europe, the numbers are very similar. Rarely a continental European country outside of the Baltic countries goes above a quarter of the population that somehow is either financially literate enough, or the regulations in the country are conducive to financial inclusion. So lots of potential still underutilized in the majority of countries in the world. Some countries like China are ahead of everybody else. This is why we're very excited to have Zhao Li, and she will be the first presenter to tell us what is so different about China that more than half of the population already is very active in terms of fintech, so to speak, services. With this, just some house rules. So we will have 3 presentations, 3 PowerPoint presentations, about 8 minutes each. And then we'll have a conversation with you. So speakers, please stay on time so that we have plenty of time for discussion. Zhao Li, please.
Yeah. I'm Zhao Li. I actually comes from JD Digits Research Institute. Previously, I worked in Shenzhen. So today, I would like to introduce our practice in fintech field. So I guess most of you guys don't know what is JD. So JD is kind of Chinese version of Amazon, and we sell almost everything. There are more than 5 million different kind of product on our platform, and we served 400. There are more than 5 million different kind of product on our platform. It can be a bottle of water, or it can be a house in overseas. So I think our business model is that we have the strongest supply chain system around the world, I think. How can I say that? We have like 211 policy. 211 policy means that if you place your order between 11 a.m., then we can guarantee you'll get your product by today. So if you place your order between 11 a.m. and 11 p.m., we can guarantee you got your product by next day. So it's not next working day, it's next day. And how we can do that? Thinking we actually sell 5 million different kind of product. It's not like that our delivery guy outran the others. It's like we can predict how many products will be sold in the following 24 hours or 48 hours in certain area, and we actually can place your order even before you realized, then we can deliver your product in the nearest warehouse. So this is how our business model works. So that's why we have the strongest supply chain system. Then we actually have all the information about our SME on our supply chain system. Let's say I just give you one example. For all the mobile phone in China, like 1/3 of the mobile phone to half of the mobile phone in China actually are sold on our platform. So we actually know whether your product is popular than your competitor, and we know how many products you will sell in the following months, and what's your income. So we know better about you than you actually. So that's why we can actually issue all the financial loan within just 1 second. Yeah, it's on our platform. You use a mobile phone, then you fill some forms, then we can make sure that you can get your loans within just 1 second. It's not only for the consumer finance, it's also for the supply chain finance, which means we provide loans for the SME on our platform. So this is a very interesting and new ways to do business. It's totally different from the conventional bank. I just gave you one example. In our risk control model, there are more than 600,000 variables. So we almost use everything to predict your willingness to pay back and your ability to pay back. So this is a number. We actually already served 200,000 SME and 400 million users, and we issued 500 billion renminbi loans. This is the data for last year. Okay, so next I will show what happens in China nowadays. In this picture, you can see this happens in almost every restaurant in Beijing and Shanghai and our first-tier city in China. You use a mobile phone. There are a QR code on every table in the restaurant, so there is no waiters there. You use your mobile phone, then you scan the QR code, then you order your dishes, then your dishes will be delivered to you. Sometime in some restaurant nowadays they are delivered by machine. It's not by people. So not to mention that you can pay all the things by mobile phone. It's not a joke that in Beijing nowadays, even a beggar have the QR code. Otherwise, they will have nothing. Because I haven't used my wallet for like 3 months at least. Okay, so this is how we sell movie tickets in China nowadays. There are almost 80% movie tickets are sold on mobile phone, and you can choose your seat on your mobile phone and maybe 24 hours ahead. Okay, and others, almost every product are sold on mobile phone. Let's say this is kind of insurance, and this is a new way to sell the insurance. It's just like a crowdfunding. We collect money from everyone. The pool is very large, so we use blockchain to make sure that every information is authentic. And if somebody say, okay, I got very sick, and we will just issue the loan to them, and the blockchain system will make sure that all the information is authentic. Let me introduce two most fascinating cases. So the first is about the pig. So how we issue loans in the pig farming industry. So this is kind of like, it's not like, it's a technology comes from our digital technology competition. It's called GDD competition. So we collect all the data scientists around the world. In 2017, the winner of the competition is pig face recognition. So in China nowadays, the face recognition is not a thing at all. So everybody can do that. So what we do is that we do pig face recognition. And after all those nerds do that, they don't know what can they use the technology. So they consult some professors in China Academy. Then the professor said, oh, this is actually very, very important technology in our field. Then we are very curious. How can we use that? Then later on, we design a very, very beautiful system. Let me explain the system to you. So we build our own digital camera. The normal digital camera, they cannot use in the pig farming area. So there are too many dust and it's humidity. So what we do is that we build our own digital camera, and we link the digital camera with digital fence, so they actually can classify the pigs, and we also can give the weight of the pig in very accurate. So let's say we can predict after 3 months later, then the pig will be fed around 100 kg. And for the other crowd, we can make sure, okay, this pig, they will be 150 kg, something like that. So this is actually how we use the technology to standardize the whole industry. But the standardization is very important. Why? Because if we can do the standardization, then all those things on the supply chain, they can be processed by computer, like how much you can sell. Previously, they just send people to the pig farming industry. They go to the farm and they weigh the pigs and give different price for different kind of pigs. But after we can do the standardization, then all these things can be done by computer. So we actually can save $7 per pig after we do the standardization. But let's say there are actually 700 million pigs consumed in China per year. So this is a $5 billion industry per year. So then after we use the technology to standardize the whole industry, we can issue loans to people who want to use the technology to rebuild the supply chain system. So this is one case. The other case is about chicken farming industry. So the chicken farming industry is another kind of way we issue loans, use technology. Actually, there is a guy come from Wall Street. They come back from Wall Street and they check the chicken farming industry. They just calculate all the risk in. They said this kind of chicken farming industry, we can use a risk control model to build the industry better. How can they do that? They just calculate everything in. For instance, the weathers, the survival rate, and maybe the waste of the feeder. Then after you calculate all the risk in, and we actually can make sure the feeders, the food of the chicken is delivered day by day, and the interest will be calculated only after the chicken eats their food. So this is how we make sure the interest of raising a chicken in 48 days the interest is less than 1 cent in US dollar. So that's why how we can issue the loans to people who are in very isolated area and their financial burden is very, very low. So these are two cases I like very much. And this shows how we use the technology to rebuild the supply chain and to rebuild the industry. And we can issue loans with very low interest and help the industry to improve their efficiency. And another thing I want to show is that since everything is online in China nowadays, then we are just wondering what the digital China looks like. So we use we collect almost all the data in China. We use the data in Tencent company, in JD company, in Citric company, in Didi company, and Meituan and Dazhong Dianping. So it's almost include everything. For the first one, the Tencent, it's like WeChat and QQ. It's like the Facebook and Twitter. And for JD, it's like Amazon. And Ctrip, it's like the TripAdvisor. And Didi is like the Uber. Meituan and Dianping is like the Yelp, something like that. And we collect all the data, and we actually draw a digital map of China to show the activities. And we find that actually digital world is more skewed than real world. We can say that for the top tier cities, they actually account more shares in digital world than in real world. For instance, in this picture, you can say that Guangdong, Zhejiang, Jiangsu, Shandong, and Beijing, the top 5 province in digital world, they actually account for 43 shares, but in GDP, they only account for 38% of GDP. But this is the data for the last year, and in this year, we actually in China there are more apps comes. They are targeting to the people in the 4th tier city, 5th tier city, and 6th tier city, like the new apps like the Qitoutiao or something. So those apps, they actually attract the people in very, very isolated area, and we think the genre of those kind of apps, they can change the activity of the whole Chinese people, and we hope they actually can help those people we hope they can help those people left behind to catch up with the top tier cities. So this is kind of IT plus industry, and we also find that IT plus industry is polarized in top tier cities. But also we think that with the help of the internet, more industry, they looks alike. For instance, the top tier city, internet plus retail, internet plus finance, internet plus transportation, all the top tier cities, they are almost the same. So we can say that actually for the internet plus, we can say the Matthew law actually works, which means that the top tier city, they always do better than others. Okay. So this is my presentation. Thank you.
Thank you very much. Thank you very much, Zhaoli. So 2 messages that at least I got. We know more about you than you know about yourself, so that can be both positive and slightly worrying. And then on the positive note that by next year or by this year in China, they're getting to 3rd tier cities, which are around 10, 15 million people. So like London basically finally would make it if it were a Chinese city. Irina, please.
Good evening, and thank you very much for having me here tonight. As Maria kindly said at the very beginning, I work in Grant Thornton, and more specifically in our financial services advisory regulatory practice. As part of that, I work with a lot of big financial services institutions, but also a number of fintechs. And I'm afraid I'm bringing you back to the UK market rather than the exciting Chinese market. And as much as I find regulatory world exciting and fascinating, I don't, by the way, I thought that tonight I would like to share with you a little bit of more holistic view as to how the fintech market looks like in the UK and the key players, how they interact between themselves, and draw specifically more onto the role of the regulations. I thought that would be a bit more use for you, given that many of you may take this route. So for that reason, I would like you to be with me on the journey to look through the key players on the market, their relationships with the fintechs. We're going to look at those in more detail, and then finally we're going to have a look at some of the current initiatives that the UK regulators are undertaking to support the fintech market. So if we look at the UK fintech market as it currently stands, we can split it into four main groups of participants. Investors, as every other startup, fintechs need capital. Fintech partners, and by that I mean big traditional financial services institutions, because as they grow, they eventually find out that they need to partner with somebody to grow even further. Consumers, because ultimately there are those who benefit from all the services and the products, and regulators whose main role is, broadly speaking, to protect consumers as being participants on this market. Then if we analyze each of those stakeholders in more detail, we find out that there are four key drivers that define the success of the relationship between the fintechs and the key stakeholders on the market. And this is the so-called fintech governance model, which is over here on the board. And it's a very simple model, but what you find out is that there are four things which all fintech firms simply cannot afford not to do right if they want to be participants in this market. So let's have a look at each of the stakeholders in turn. Starting with investors. So what are investors looking for when they want to invest in a fintech firm? Well, they all start with something called due diligence process. I'm sure you all know about it. It's a very lengthy, comprehensive, and very often a painful process to evaluate the fintech firm, taking into account all financial, all legal aspects. It's basically a very long checklist. Amongst this very long checklist, though, there are four key things that define and determine their decisions. The first one is who they're dealing with in this fintech firm, i.e., who are the board and the senior management. Is the firm still run by the founders? Do they have professional management in place? Are these people knowledgeable? Do they have experience? Do they actually know how to run a business? Secondly, they're obviously very interested in the business model because ultimately it's about return of investment. Regardless of what their expectations in terms of return of investment are, though, they all want to understand what's the operating model that underpins this strategy and the fintech firm's vision. So they are quite interested to understand the structure and the target operating model on the fintech firm. Thirdly, all professional and experienced investors know that regardless of how great the strategy looks like on paper and how innovative the technology is, it is ultimately down to people to make things success. So the third thing they look at is actually HR risk. Then fourthly, and perhaps one of the things they start with when they assess fintech firms is trying to look at risks. And very high on their agenda, alongside financial risk, which obviously accompanies every single investment, is the regulatory risk, and particularly where do fintech firms sit on the regulatory spectrum. And this is because investors simply sleep better if they know that the fintech firms are regulated. And obviously this is associated with the fact that there is additional scrutiny related to that, but also decreases their reputational risk. And by that, I mean that if you invest in a fintech firm which is regulated, it's not impossible, but it's less likely that they will be engaged in some kind of dodgy activities for which they don't have the right permissions, and therefore all the detriment as a result of that. So regulatory status absolutely on the top of their agenda. Then let's turn to fintech partners. Well, there are those big traditional banks and those big insurers which are looking to improve their services and their products, so they realize the potential of fintechs. Interestingly, the market has evolved significantly in that area, and whilst fintechs initially started with the concept that they will be eventually bought by financial services, big financial services institutions, they finally got to the point that actually partnership is equally profitable and leads to growth. So now in this B2B model, what are the key criteria for fintech partners to make a choice and to decide who they partner with? Well, they follow exactly the same thought process as investors. So they want to know who are the people who lead this fintech firm. They want to understand whether the people who are at the top can actually fix a problem if something gets wrong, because they do. They want to know if they can be relied upon on driving forward the firm. They want to know whether they can be held into account. Secondly, they want to understand what's their operating model that underpins that strategy again. And this is because they want to assess whether this model is actually compatible with their own business model, whether it's sustainable over time. They are also very interested in people, and more specifically into the cultural match and the mindset fit. There is still this kind of mismatch in terms of the people working in fintech firms and the people who work in big financial service institutions, and particularly with idea and with regards to regulations. So financial service institutions really want to understand that people who work in fintechs understand the need and the importance of the robustness of arrangements they've got in place, the need for being regulated. They also want to know that people can actually deliver the services up to the standard they deliver to their very own customers, as big traditional banks, for example. And then outside these three things, the absolutely biggest thing on their spectrum is compliance and how fintech firms tackle compliance. And this is not because big banks and big insurers suddenly have become altruistic and they really care how fintech firms tackle their compliance. No. This is because every single potential partnership with fintech firm increases significantly their compliance risk and the cost for managing this risk. Taking GDPR as an example, well, every single potential partnership would involve some kind of data, customer data, data transaction, data processing. If the fintech firm has got that wrong, that immensely increases the risk for the big financial service institution as well. They simply can't afford to do that, and they're never willing to take this route. So if fintechs really want to be there in terms of partnership, they need to tackle compliance. Then, if we look at consumers, and what they care about? Well, obviously the product and the service. Better service, faster service, more cost-effective, more efficient, slicker service. And that's quite right. Then, if you think how this immaculacy is delivered, well, it brings us back exactly to the same points. Strong management team, efficient and flexible target operating model, and good people. One of the thought that consumers shouldn't be concerned, and they're not concerned with regulations. Yes, but no, they are, and they understand the risk. And when you think why this is the case, well, the case is there because, say, let's take the UK fintech market, for example. It is 50% dominated by banking and digital payments, 20% by personal loans and credit loans, and the rest is insurance and asset management. And what's the common between all this? Money. Though the fintech providers operate with our money, your money, my money, the consumer's money. And consumers understand that. So that's right, they've got, quite rightly, the demand and the request to insist on fintech providers to have got right all sorts of AML arrangements, for example, or the fraud prevention arrangements, that they need to know that they understand know your customer risk. They are quite concerned about privacy and cybersecurity. And when you think, why is that? Well, trust, the thing that defines the financial services market. If you ask consumers why, for example, for those that haven't switched from their traditional bank accounts to fintech or challenger bank, for example, they all have the same response, and the response is trust. And trust is one of those things where it is probably the most difficult to gain and the easiest to lose in every single relationship. And it's not any different between fintechs and consumers. So if fintechs really care about tackling and being there with consumers, they really need to think about their regulatory arrangements. Then we've got the regulators on that side. I'm not going to talk you through regulations here because we don't have enough time, but also I hope you've grasped by now why these are important. But I just wanted to very briefly mention some of the initiatives that the UK regulators are currently undertaking. Interestingly, by the way, the FCA is seen as the best regulator in the world as creating fintech-friendly environment. I just thought that's an interesting thing to know. So they've got currently something called the Fca Innovation Hub, which basically provides direct support to fintechs who are trying to launch new products. They've got the regulatory sandbox, which I'm sure many of you have heard about, which is basically a safe environment to test new products, the potential customer implications, and at a lower cost. They've also got the Asset Management Authorization Hub, which is another way to support firms through their authorization process and after authorization. The Bank of England has also established an accelerator, which aims pretty much the same thing as the regulatory sandbox, i.e. supporting the fintech firms and testing on real issues their new products and providing them with feedback. There are a number of government initiatives as well, in the sense of creating a number of industry bodies. Just to wrap up, regulations and regulators obviously dare to protect consumers and the market to a great extent, but they are also a very tested and trusted method to actually support fintechs, simply because they are viewed by the other key players on the market as the necessary safeguards. So hopefully I've convinced you by this point that regulations, they are not to hinder the market, but actually to support it. Thank you.
Thank you very much, Irina. One topic that will hopefully come back later is this stark difference between the presentation on China and in the UK, where all the businesses or fintech-related companies that Julian showed us are basically new companies. They were not around a decade ago. While we just saw the main, or some of the main players in the fintech market in London or the UK, most of these are very established players like Barclays and NatWest and so on that have been around for a long time. So one question that arises is why this difference? We'll hopefully come back to it later. Next is Julian. Julian, please take the floor. Just introductory comment on my part is that when we were setting up this panel, I expressly asked our students in the law departments to give us suggestions of exciting lawyers, and they basically came up really with one name, Julian's. So we're very excited to have you here. Julian, please.
Anybody who finds my career exciting needs to explore some other careers, I think, probably, but never mind. Thank you very much indeed for having me here. I'm a lawyer from Linklaters, as Simeon said. I'm primarily a technology lawyer by background, but I keep ending up working with financial institutions, so now I've become a fintech lawyer, which is fun. And I've rather foolishly agreed to talk a little bit more about regulation, although it's not really my area. So hopefully a layman's view of how regulation impacts fintech will be useful for everyone. It'll be boring for those who are regulatory specialists and hopefully a bit enlightening for those who don't, but maybe it's boring for them too. But we'll see. I'll try to be a little bit between the two guys, a little bit international with a little bit of UK flavor too, because I think there's some very interesting different perspectives to take from different markets around the world. So if we start with the super macro view of how financial regulation works, because that's the industry we're really talking about, this is the thing that differentiates fintech from other tech industries. It's built up of four major components. Financial stability, making sure that the market, the economy as a whole, is protected by the activity of the organizations working in financial services. Prudential regulation, which is the way in which each of those regulated institutions manages themselves, stays above water, heads in the right direction, keeps being able to service their customers. Conduct and fairness, the way in which they treat the individual customers, whether they're people at a residential level or large institutional investors. There are detailed rules about how to treat each of those different categories of customers. And often in the financial regulatory space, there's a very close interaction between the regulation of the industry itself with the rules for running financial services and the competition between entities within that organization that interact with each other. That is, from my experience, already probably the most complex regulatory environment of any industry that's out there. And then along come a bunch of technology companies who want to play too. And they don't have the same regulatory background. But when we start talking about fintech in the context of financial services, we have to put the financial regulation in the middle, because if you want to play, you have to know the rules. But then you bring a whole suite of other rules which apply to everybody into play as well. And we'll see why this is so important when we talk a little bit more later. Because previously, financial regulators knew the companies they were talking about. They could be big banks, they could be wealth advisors, they could be loan providers, but they were understandable. But now, just as Simeon has just said, suddenly these regulators have to deal with very fast-moving, very innovative companies, sometimes at a huge scale, like JD. And so all of those rules in the middle, which they were worried about, they suddenly need to worry about in a very different way. Take, for example, data. As we heard from Julian earlier, these organizations know you better than you know yourself. And To a certain extent, that's true, because they watch your behavior and they can put logical rules around what you're going to do next in a way that you may not be able to do yourself. And the regulators in financial services have come up with a concept of information asymmetry, which means you start to engage in your normal way on your mobile phone with a provider of a fintech service. You're on the bus, you're in a rush, you want to transact quickly. As soon as you connect with that person's service, a huge amount of data about you is available to them. So they can decide in a split second what to offer you, what your price elasticity is, what your appetite for risk is. All these things are done often automatically by the algorithms within the fintech itself, and they can offer you things which they really think with great confidence you're going to buy. This is a million miles away from the person-to-person interaction, which was the basis for the financial services, which built the basis for the rules in the first place. That's where the regulators start to worry a little bit. Used to be, we started to impose on the financial institutions an obligation to be transparent with their customers. You need to say exactly how this product will work so that they can make an informed and careful choice. You give them the information, they walk down the high street, think about whether they liked your product, go into the next bank, get the same comparative information from them, go home, have a cup of tea, think about it, make a sensible decision, and then buy the product. Nowadays, you want to buy within 10 seconds by the time the bus gets to the bus stop, and you want to do it now. And you don't want pages and pages of screen of legal disclaimers telling you what you should be careful about and what you should be thinking about before buying stuff. It's out there if you want to click it, but how many of you actually read the disclaimers? Not so many. So this is a whole new world of, I want it now, and I don't really want to read a whole bunch of stuff. But at the same time, all those rules about treating customers fairly are still meant to apply. Hence, when you have an organization with 500 million customers, you see also the concerns start to rise around financial stability as well. Fortunately, we have very thoughtful companies out there who look after their customers very well. But there's a lot we can talk about data later, so we'll probably leave that to the questions. I want to just move on a little bit. Because there's an interesting balance here in regulation between the desire to foster competition within financial services and the desire to manage risk. On the competition side, there's lots of emphasis from the regulators about creating choice. Fintech companies are great for choice. They look at the way markets work, they find points of inefficiency, pain points for the customer, and they build things to overcome those difficulties within the system. And then they offer compelling opportunities for those customers. They provide really easy access. Like I said, you can buy your mortgage on the bus rather than sitting in a branch somewhere for hours on end going through KYC. And they can innovate all the time. All these things are great, but they generate significant, sometimes systemic risks within an industry which the financial regulators haven't had to grapple with before. The level of risks that are potentially exposing whole economies to through fintech are significant, and the consumer protection challenges are significant as well. So as a result, the regulators have this antagonism they have to deal with. They want to keep competition thriving, but in a manageable way. And so how they seek to do that is through a variety of different regulatory levers that they have. Getting it right is a challenge. So on this side, they take some specific steps because they're worried that the big organizations that have been running financial services for years and years, the big banks that we heard about earlier, won't allow access to their customers. They've got too much information, they've got too much power, so they need to be forced to open up the information about their customers to let other people play. They need to make it much easier to switch bank accounts. And they need lots of competition rules to make sure they don't collaborate with each other in a way that excludes other people from the markets. Over there on that side, but on the other side, opening up all of that information to technology companies that aren't subject to the same level of regulatory scrutiny leads to privacy risks. It leads to potential consumer protection issues as well. How to balance the two? It's very early days. As a result, different jurisdictions have gone to different lengths to try to create the right balance between these conflicting forces. So what I thought I'd quickly do, so we don't have very much time, is just to run around the world with a slightly strangely coloured map, because I couldn't find a very good one earlier, and just look at how different countries are trying to manage that balance that they have. We'll start outside of Europe, because it's more fun to look a bit around the world. Let's look at the US. What's interesting about the US is, over here, San Francisco and California, we have a huge engine of financial technology innovation. With China, I'd say it's probably the two jurisdictions in the world which are driving the most innovation, maybe with London too. But over here, we've got all the regulators, all of the federal regulators as opposed to the state regulators. And unlike the UK, where you have a fairly cohesive group of regulators who talk to each other an awful lot, you have lots of different regulators for different areas of the financial services markets. And so far, that slightly less cohesive group of regulators and a slightly more anxious political climate has meant there hasn't been so much acceptance of innovation and risk-taking within the fintech scenario. If you look at crypto, for example, there's been a lot of enforcement by the regulators, a lot of nervousness. It's one of the few areas where investors over there in the US look to Europe with jealousy and look at the regulators over here and say, wow, you mean I can actually do that over there without getting in trouble? That's fantastic. So there's a lot of inhibition over in America about the investment in crypto and other areas which you don't get in Europe, which is great. But then they look over to Europe and they see the GDPR, and they're all terrified. The idea that you could be fined 20 million euros for just doing things with data which you thought was perfectly sensible, as Google might think. So you have that over there in the US. And over here, all sorts of exciting things. I'll leave you to talk a bit more about China. But you've got Singapore, one of the most enthusiastic endorsers of fintech innovation as well in that region, and Hong Kong, sitting close together from a geographic perspective, but taking completely different approaches. Singapore is inviting innovative technology firms into their sandbox to play, to create new things, new models and products, whereas Hong Kong sees that as a risky approach and is only bringing their existing regulated firms into their safe environment to test out new products. So even closely competing regulators are taking entirely different approaches to try to find the right balance between risk and innovation. The PRC is there doing amazing things and with huge numbers of data points to create such competitive products. If you're an insurer and you've got 500 million customers and you can monitor their behavior, you can price your insurance products so effectively, the rest of the world better watch out. It's an amazing way to do business. And in the middle, we've got 3 major European centres who are all vying for the fintech crown. London's been pretty comfortable. It's been doing pretty well for the last 10 years. But we've got a bit of an issue in March next year, or this year even now, sorry, I forget. And it's been very interesting to watch Paris and Frankfurt positioning themselves very enthusiastically to pick up any financial institutions that might want to explore the opportunities of continuing to do business with the rest of the EU after London potentially falls away. So, where previously London had all of the advantages of being the gateway to Europe for America and for the Asia-Pacific region potentially as well, no longer the gateway, some might say. And so many people outside of Europe are brushing up their French and their German and looking for other places to really use as a launch pad for fintech into Europe. So London better be careful. London better continue, as Irina said, to be the most accommodating and innovative regulator, or things will not look so positive for us in the future. That's probably enough for me. I'll sit down and we'll have some more fun and talk. Thank you very much.
Thank you very much, Julian. This map actually does provide a good starting point also for some of the discussions that I'm sure we will have. I noted that Sofia, Bulgaria wasn't on it, but this was probably just an omission since when the Brexit referendum surprised us, how then the Bulgarian Minister of Economy came and very confidently predicted that a lot of the financial sector from London will move to Bulgaria. Hasn't happened yet. Probably many other people had similar thoughts, but clearly there are services beyond financial services in London and in other large cities that you mentioned, like New York, Singapore, and so on, that make us put up with regulators at least up to a point, and then what's that point? I guess the discussion can tell us. So we have about 35 minutes for questions. I'll go straight into the questions. Please introduce briefly yourself, and then if you're pointing the question to a specific member of our panel, please let us be. The gentleman there immediately lifted his hand. And we'll try to go right to left and then upstairs in the balcony.
Hi, my name is Philip Drum, and I work for a fintech in town. I was curious how you think the distribution of the William and Glenn's Fund is going to change the landscape of fintechs in the UK.
To any particular member or just?
I mean, I guess maybe Irina, because she talked about the regulation, and she mentioned some of the fintechs, but I saw like HSBC and large banks up there.
Yep. We'll collect maybe 3 questions a turn so that people can compose their thoughts. So 2 other comments or questions from the audience. Who is next? Right, the lady just behind you.
Francis Coates. I work for an insurance broker called the Ardonna Group. Maybe a controversial question. Do we need to, and it's to anyone, do we need to balance an individual's right to privacy with what sounds like the pretty scary march of progress in China where, and it is an assumption, so apologies if I'm wrong here, there is not that strict and strong protection, and it enables far faster innovation?
A question that I think everybody has on their mind, so it's good that you put it out very early on. One more maybe before we turn to the panel. Anybody? Yes? The gentleman right behind you.
Hi. Maybe for Julian or Irina, how smart contracts and the application of blockchain can bridge the gap between data protection and opening up and automating this big volume of data?
Thank you. I thought that maybe we start with Julian this time, since he had the benefit of first listening to the other presentations on privacy. I think this topic everybody will comment, and then of course on blockchain and some of the other topics. Julian, please. Okay. You have the option also to pick which questions you want. So just closer to the microphone, please.
Sorry. Okay, well, I'll talk a bit about data and privacy to pick up your question, Francois, because that's easy, closer to my heart most of the time. So certainly a European principle that an individual's right to privacy must be balanced with the business interests of other organizations. I think nobody will debate too much about that. But it's a bit more complicated in fintech in that the regulators require you to understand your customer very well. And so the suggestion that a more detailed understanding of your customer's behavior is somehow a sinister thing doesn't really work in financial services. There's a very careful balance to be struck. And what I see at a more commercial level is that the sort of terror of data regulation that comes now, and also financial services regulation, which really regulates data security in a very aggressive way. There are potentially huge fines there as well. Does act like a very significant inhibitor to quite a lot of the innovation that's out there. There needs to be a balance struck. And I think at the moment, in some ways, the pendulum may have swung a little bit further back that way on the financial services side. So I see quite a lot of organizations trying to collaborate with each other, but they have a privacy function which is saying to them, no, you can't do that, you can't do that. And you're losing years and years as a result in the innovation process. I think there's a middle ground. It's not fair to say that China doesn't have data regulation. It has quite a lot of data regulation as well now. It's just a bit different. I think it's a bit easier to innovate. And Goldilocks, I'm not sure where Goldilocks is. The US doesn't have particularly strong data regulation as well. Nowhere's got it quite right. We're swinging that side. Maybe China's swinging more on the innovation side. Somewhere in the middle is a happy path. But maybe I'll let you talk a little bit about data in China and whether everything feels good and protected, and we can come back to blockchain in a minute.
Okay. So maybe Zhaoli, Irina, on that question of data privacy, and then blockchain. And the first question, let's come back to it.
Okay, so for the data privacy, I guess a lot of people are actually concerned about their privacy, but frankly speaking, in our system, I guess, although we know you better than yourself, but actually you are anonymous. So this is, it's kind of tricky, but actually when we calculate your willingness to pay and your ability to pay, we do that. In our system, it's kind of anonymous. And it's like when we issue the loan, we don't care about who you are. It's just the system tell us, okay, this guy, he is able to pay back, so you can issue the loan to them. So actually, in China, as far as I know, when I worked in Tencent, actually for different kind of product, for instance, Tencent have many kind of product. You have WeChat, we have WeChat, and we have the map, and almost everybody use them, but actually the data is strictly separated. Even in your own company, we don't combine all the data together, because it is very risky if you combine all this data for specific people. If you combine all the data together, you actually know everything about him. It is very, very risky. So in large company, we actually divide the data separately. Even physically, it's separate. So for like when you do WeChat, and you also have your you also have your record in the map, but actually the data is separate. Especially as far as I know, in the big company in China, they are very sensitive to all the regulators, and we hope there is a specific rules, because it will make our business much easier. Yeah, it's like when you are a very, very small company and you can do a lot of things, because it's very, because you benefit more to violate the rules. But for the big company, if you are caught, then it's a disaster. You will lose everything. So I think it's kind of, the big company in China actually is leading the regulator. They are forcing the regulators to set the rules. In last year in China, there is kind of P2P business. For some small company, they break the rules, so it's a disaster to the whole industry. Then all the P2P business becomes almost illegal in China, and it harms everyone. And especially the leading companies, they hope the government have specific rules, then they can follow the rules and do their business in the right way. Yeah, thank you.
Thank you. Irina, any comments?
I couldn't agree more with Julian, to be fair, and I think he drew it quite clearly in his presentation as well. So the regulations are there mainly to protect customers and consumers. So when you think of privacy issues, as with many other regulations and issues, fintechs simply need to shift their mindset in terms of what is their starting point. And innovation is great, and it's absolutely amazing to have it, and that's the way forward. But we need to think as to what are the customer implications, and is there any kind of customer detriment there? Because ultimately, they are the receivers of these products. And if they suffer, if there is any kind of harm as a result of that, that's also not good ultimately for the fintech businesses as well. And what the regulators here in Europe are trying to do, Open Bank is a really good example, where they are trying to kind of almost balance exactly the two challenges. So on one side, they are trying to almost boost innovation by opening the market for more competition, but also they are looking to do that in a much safer way by obviously all the regulations in open banking and trying to go from screen scraping to APIs. And I'm not a tech expert, so but they are trying to get there, and they will eventually get to that point. So there isn't necessarily a conflict. I think it's just a gradual evolution, and we will get there definitely.
Thank you. Blockchains. You, Julian, started as a tech person, you told us. My also not expert view is that blockchain is such a popular word that whatever you do, you say, I have blockchain, and suddenly your valuation shoots up. But is there anything useful in blockchain in this particular discussion?
So blockchain is a very attractive conceptual proposition because you can draw nice pictures and assure people that it creates a very robust integrity around data and around transactional processes. And it certainly has created a lot of buzz, and there is a lot of potential around it. But the number of full-scale blockchain propositions which I get to work on, which are going out into the market, is low at the moment. A lot of the time people call it a technology looking for a solution rather than the other way around. Often blockchain isn't the solution to the problem that you're trying to fix. And I think there's quite a lot of areas where, to pick up what we talked about earlier, blockchain doesn't necessarily follow all the rules yet. Data is one of the key areas. The whole point about blockchain is it gives you this immutable record of what has happened. And then privacy law tells you only keep data for a certain amount of time. It says you must be able to identify who's responsible for the safeguarding of that data. You've got a ledger which is distributed amongst maybe thousands of people. Who's responsible if something's wrong? All of the ways in which the current regulation of data works don't work very well with blockchain. So if you want to have a successful technology company based on blockchain, you might have to break some of the rules. That makes it quite tough in fintech. So there's a lot of potential there, but there's a long journey that both technology needs to go. It's very inefficient in some ways to use blockchain because it takes a huge amount of processing power just to create a record and keep the integrity you're looking for. And the regulators have got to figure out that the benefit of the integrity you get with blockchain is worth breaking some of those principles which underpin existing regulations. So this is not a tomorrow it's going to rule the world thing from my perspective. Lots to do, but you've got a lot of bravery required from regulators to get there. That's my view.
Thank you. Maybe raise a few other questions and we can come back to some. Dimitri on the right there.
So I'm Dimitri Vagianos, a professor of finance at the LSE. So I have a question about the kind of business model for JD that you sketched in your presentation, which is somehow it combines this, as you said, this Amazon kind of retailing structure with the functions of a bank or a financial intermediary, that they handle also the transactions and they offer financial products. So I want to know two things. First of all, what are the synergies that makes efficient to put both types of functions under the same roof in the same company, and why this model has not worked so much so far in, let's say, in Europe or in the US? I mean, or maybe is the future for Europe and the US to evolve towards that model of the kind of company that you, JD kind of, for example?
Mm-hmm. Thank you. Another question or two somewhere in the audience or upstairs? Yes, please, right up front.
Hi, my name is Matteo Bauer, and I'm a student at UCL. I think it's a topic that we touched upon a bit, and I guess my question is, in the UK, really challenger banks have dominated the kind of the fintech space, even though I guess really the dominant banks like HSBC are much better positioned to create fintech propositions or also handle the kind of regulatory constraints. So I guess my question is, why is this the case? And maybe why is it different also in China?
Mm-hmm. Yeah, no, very good question of why is China so different so far, at least, from the European market and actually from the American market as well. So is China showing us the future, or we started from such different initial conditions in the US and in Europe that the market will be developing differently from here on too? Is there one other still up front right there? One more question, and then we'll go back to right there, the gentleman.
Hi, I'm Ben. I'm also a student at UCL. This is directed at Arena. You mentioned that consumer trust is the hardest thing for some of these companies to really gain. And we've seen, from a perspective of kind of consumer adoption, we see that it's really only, China, Estonia, these countries where they they have kind of government-backed or government-sponsored fintech kind of propositions, and they're the only countries where most people are, the majority of the population is using fintech products. And so I was wondering, do you see any future in the UK or Europe for any kind of government-sponsored or state-sponsored fintech framework or fintech regulatory proposition?
Thank you very much. So let's start with Jauli, then Julian on challenger banks and so on, and then Irina will handle the last question. Jauli, please.
Yeah, thank you.
Just closer to the microphones, all of you, please.
Okay, so for the GD companies model, can we use those models in other countries? So this is kind of very similar question as the second one, why the fintech is so successful in China, and can such kind of thing be very popular in overseas countries? What's the difference? And this kind of question we have think about that many times, and I think the reason why China digital economy is so grow so fast in the past 10 years, I think there are actually two reasons. First is China is a very huge and single, it's a very huge country, and but we use the same language and we use the same currency, and so which makes the fixed cost of any kind of business model very high, but later on, since the variable cost of those business model is almost zero, so it can cover all the fixed cost. Let me give you an example. For GD business model, as I mentioned, why we are so successful, because we have the most powerful supply chain system around the world. But if we build such kind of business model in like European, we must make sure this is a very large country and they have huge population. Otherwise, the fixed cost for the supply chain system will be very high. And later on, when there is no much consumers there, then you cannot get your investment back. So there are another numbers. JD, in the first 5 years of JD, we almost get zero profit. Every year when you say what we actually lose a lot of money in the first 5 years. And I think we only get profit in the last 3 years. So this is how we use the zero variable cost to cover the very huge fixed cost. And this is the first condition. And the second condition is that in China, I think we are, maybe we are very lucky, but I think the consumers' awareness about the fintech is the highest around the world. How can I say that? In China, the people's between 5, maybe 7 years old to 70 years old, when they see a QR code, they know what they should do. They will bring the mobile phone and scan the QR code. So this is the most mature consumer around the world, and the number is huge. We have like 1 billion people there, and they know how to scan the QR code. When we go to the overseas countries, and when we check whether we can copy the model from China to overseas countries, the first concern is that we have to educate the consumer, and the cost is very high.
Mm.
Yeah.
So fixed costs, a lot of it. Challenger banks, or in general, this topic of, it's the same rubric as Zhaoli said, the second question. So why are they so different?
So I think right now you might have a bit of a honeymoon period, if you like, if you're a challenger bank. You have all of the regulation that I talked to, which is forcing the incumbent operators to open up, give their data to the challenger banks. And you also have, you take a typical innovative mentality, move fast and break things. That's not the kind of thing that you hear spoken much about in a big bank. That's terrifying from a risk management perspective. So you have these companies which are coming in, which are testing the boundaries, if you like, and they're being given so-called easy access to customer base as well. And I'm sure a number of you have accounts with a challenger bank and perhaps an old-fashioned bank account as well. And sometimes I mustn't mention individual brands or I get into trouble, the service might drop sometimes, okay? And it might drop for a little while. But you love the service, you love the interaction, you kind of don't get too mad about it. And you continue to use it because it gives a compelling price or it allows you to manage across all your finances, if you don't. If that same failure occurred at HSBC or Lloyds, the regulators would kill them. I mean, you have seen CEOs of big banks being dragged in front of Treasury Select Committees to talk about IT failures. That's the mindset that they're bringing to this innovation, whereas the challenger banks, not so much. But we're at that point. They're growing scale. They're getting a little bit of an easy ride of the regulators, I would say, at the moment. That doesn't go on forever. They will get scale. They will become systemic. They will need to be very careful. And so you'll watch that decelerate. Their costs will increase. Life will return a little bit more to normal. That's my expectation. A bit from a European perspective. I don't know if others want to say otherwise. Irina?
Can I just add on the challenger banks first a little bit?
Yeah.
So an interesting point actually that we found out in our work as well, working with our clients, is that one of the things that the big financial service institutions, the big banks can do, for example, is the level of flexibility the challengers have. And it's also the legacy of the systems they've got. So imagine, I think it was Anthony Jenkins, the ex-Barclays CEO, saying in a podcast a few months back that you go to your big bank, so you go to HSBC or Barclays, and you'll find basically all sorts of infrastructure from the 60s until today. This is just not manageable. So as Julian said, the challengers have this absolute luxury at the moment to be operating with entirely new system, in a very flexible model where they can be very agile. There is also mentality kind of thing here, but they will get there. Their systems eventually, in some time, if they don't continue to develop, will also not be the best and the fastest and the most agile in 5-10 years' time. So they will have same challenges if they manage to sustain through the market. And then they are successful when you look at them, but there is only one challenger bank at the moment in the whole UK market which actually has come with a profit. And this is not a customer bank. This is not your Monzo's. This is not your Revolut. It's Oak North, I believe, which is an SME kind of business-focused bank. So we'll see. You'll have to see, and we'll have to wait for, I guess, a couple more years to actually understand and assess as to how successful their business model is. And this is exactly the time that the incumbents actually need to catch up, and they will do that. They may not be sleek in terms of providing services to challengers, but they will get there. That was a question on the framework. So the UK government actually has got a fintech strategy. So if you look at the government...
Hopefully better than the Brexit strategy. But
shorter, I can tell you that for sure. So it has been through Parliament. Obviously, there is an all-party parliamentary group in Parliament which deals with fintech as a whole and the fintech market. There is a strategy in place, which I think it was 2016, the first time that this was put in place. There are a number of initiatives that are currently ongoing. So there are things going on, and the regulators and the government are definitely trying to support this. Bear in mind, fintech at the moment is about 33% of the global financial services market. It's not a small sector, and I think I have to quote one of our competitors here, Ernst & Young, but I think it's one of their latest reports that they evaluate the UK market, the fintech market, about 20 billion. So it's not a small thing, and it will become bigger. At EU level, interestingly, the Bulgarian commissioner is dealing with digital issues. But there is also strategy at EU level, and there are thinking as to how to support the market. But bear in mind, the difference between, and I'll talk about Estonia separately, but the difference between Europe, and that will sound terribly, okay, Europe and UK are market-driven economies. So it's very unlikely that there will be some kind of very proactive measures or whatever other support we might expect to just boost the market. There will be measures to facilitate the market and to accelerate it, but it won't be any kind of interference. The biggest interference I have ever seen on behalf of the regulators in this market is actually open banking. It's just amazing. Estonia is an interesting example. It's very digital, yes. It's all great. It looks amazing at how it's been delivered. I know I've worked with Estonia personally previously to try and understand how they get there, but it's a 1 million country. It's 1 million people country. It's so much easier to achieve results at such a dimension as opposed to the UK market. So if you look at the fintech adoption rates, for example, London is somewhere about 44–45% adoption rate, whereas the rest of the UK is about 20%. It's the geography to a great extent, it's the mentality, it's a generational thing. And Zhao says, it's the thing that actually manages to drive the Chinese market is the fact that everybody, so basically their fintech adoption rate is, I guess, I don't know, close to 100% at the moment. So that's the difference.
Thank you. One, we haven't talked much about the US. Julian, I wonder whether, since I know you do global work, there are no challenger banks in the US, are there? Or at least not to the extent that they're here in the UK. So even between these two mature markets, there seems to be a big difference, yes? Or I'm missing something?
I think so, but as I said, I'm a bit of a jack of all trades, so my knowledge of the US regulatory regime is not that great, but it's pretty tough over there. You've got chartered banks and state banks, and, you know, it doesn't have the same immediately encouraging environment for new banks, that must be said.
We have time for one other round. There are two gentlemen at the back, and then we'll also get two questions from the top.
Hi, can you hear me?
Yeah, we can hear you.
So, as you know, fintech is very much in vogue now. But as Simon, I think even you mentioned, a lot of the companies, when they even mention they have blockchain, the valuation shoots up like crazy, even though people don't really understand what it does or why is it useful there. And you see a lot of these companies raising money at, you know, who've never made any profits at crazy valuations at 5 times revenue. So I was wondering what the panel thinks is the risk that we are kind of living in the fintech bubble, of a risk or a fintech bubble materializing over the next few years.
Very good question. And the gentleman next to you had a question, and then we'll go right there.
Yeah, hi, my name is Joe Chen. I work for Euromonitor International. So my question is actually on regulation. So I think there's quite a lot of changes with 2015, where the EU interchanged fee cap between the banks, the acquirers, and the issuers. I'm just wondering if you feel like the consumers are actually benefiting from this kind of changes in regulation and if there's actually a future in 2 years' time for EU payments market.
Thank you. And the two questions of the, yes, please.
Hi, I'm Rehan Bibidron. I'm a student at King's College, London. So, Julian, you mentioned the state of regulation in the US, in Europe, and a bit in Asia. What is it like in Africa at the moment, especially countries like Mauritius, which is gearing up to be a fintech hub and a gateway to the whole continent of Africa? And do you think that the UK will play a big role in the development of both regulation and fintech business in Africa? And Shaoli, same question for China. So do you think China will play a big role in the development of regulation as well as business development in Africa?
Very good question. There was a gentleman right behind you with the final question, please.
Yes, hi, I'm Jay from LSE. So my question is directed to Ms. Zhao Li. So you mentioned that JD issue a lot of loans. When JD is issuing the loan, do you use internal funding or external funding for that particular loan? And after you have issued a loan, do you then sell off the loan directly to external parties, or you wait until it matures? And what is the rationale behind your structure and your model? Thank you.
Some very good finance questions. So we'll start with Zhao Li, then Irina, and Julian will finish.
Okay.
In 8 minutes.
So I will be quick. Actually, in China nowadays, I don't think most fintech companies, they will do business with their own capitals, because when they grab the cake from the conventional bank, it will be a disaster. So most of fintech companies, they change to the digital technology company. So that's why we already changed our name from JD Finance Company to JD Digital Digits Company. So, I mean, that not only the name, but also when we do the business, we build our risk control model, and we sell the risk control model to the banks. Basically, banks issue loans with their money, and what we do is that we sell the risk control model, and we share the interest. So technology gets the profit from technology, then the banks get the profit from capital. So that's one question, and that's the answer to your question. Another answers to the blockchain, the blockchain bubbles. Actually, I have different kind of opinion. For the frontier companies, like as far as I know, there are many companies in China right now. They are developing the new system based on the blockchain technology. For instance, we develop ABS a transaction platform based on the blockchain technology. So it's a quite long story, but the result is that we can use the technology to decrease the information asymmetry and make sure that the strangers are companies. So they actually, when they go to the system, they know when they use the platform, we actually have their consent to use their data. And so after we get their consent, actually, we can make sure the strangers, they can transact on the platform, and it will improve the efficiency dramatically. And another thing is that we actually are building the blockchain. We use the blockchain to rebuild the supply chain system. So this is a very fascinating area, like when you there is a kind of multi. It's a wine. It's a Chinese white wine, and it's very expensive. But you want to know the product you purchased is authentic, then use such kind of supply chain system based on the blockchain technology. You can know everything, and also we use such kind of system in the medicine and others. So when you got your product, you can know where it comes from, and you can know all the detailed information. So this is kind of fascinating technology. We are looking forward what they can do, and we believe they can actually change some of the conventional ways to do the business. So I think my time is up.
Thank you.
Yeah. I'll take the PSD2 question and leave the pleasure to deal with blockchain to Julian. So what PSD2 does, in essence, is simply builds on what PSD1 was. It does indeed capture a little bit more areas in terms of what needs to be regulated, but is beneficial for the consumers, to answer straight to your question. And I'll give you an example why. So I have been recently working on a project, for example, somewhere where the client was kind of issuing vouchers to consumers, and they were not regulated, and this was not captured by PSD, and could actually have massive customer impact and detriment with all these vouchers, and no one thinks of vouchers like that, but actually they should be captured by PSD too. So I agree that it's a little bit of a more stringent regulation in the sense that it almost regulates the market even further, but then, as I said at the very start, what the regulators in the EU and the UK are normally driven by is actually thinking about the consumer. So in essence, they just have to do it.
Thank you. And Julian, blockchain and the global question.
Okay, I will try to combine an answer on both Africa and blockchain. So I think...
Closer to the microphone, please.
Sorry. Africa has taught a lot to the rest of the world about fintech innovation, and many of you will probably come across the case study of M-Pesa in Kenya, which was a real innovative way to distribute funds to a very dispersed community. But what that flags is, although many people say, well, this is a model which will be replicated throughout the rest of the world, that's only where that challenge of distance is really acute, that that particular technology will have such an impact. So I think the areas of innovation depend on from the geography to geography. So that was a real trailblazer 10, 15 years ago. But then coming back the other way, we see more recently value transfer by mobile devices. You've seen companies such as BitPesa, which is a sort of evolution on M-Pesa 15 years on, where there's a business which has a big center in Africa, which has come and taken learning from London. It has a big hub in London, learned about cryptology, about crypto use to create a way to transfer value between mobile phones. And they've taken that technology back into Africa to produce another proposition which is scaling and crossing continents very well. I totally see Mauritius and other areas which have got a great regulatory encouraging regime, good tax regime, all those things as, again, a great springboard for Africa and the rest of the world. It's just a question of making sure you design your technology or product for the right markets where there's a real advantage to be gained.
Thank you. We haven't actually discussed some other large markets like India, which of course is a large market, has some of the type of features that we've discussed about China. Poverty is larger, so in some sense you can do some things in the larger cities, but not so much yet in the rest of the economy. But it's a huge economy, so has the upswing, as well as Indonesia, Vietnam, and a number of other markets with 200-300 million customers or so. So this is clearly a lot of venue for us to explore for some of our future meetings. But for now, we are right on time. So thank you to our panel. Thank you for asking questions. And thank you for being here.